Okay, this is Amber Parker. This is my video submission for the Advanced Managerial Accounting course and the corresponding paper that I just wrote. So essentially, this entire process has to do with responsibility centers and how I, as a manager, would be assessed in my ability to produce tangible results. And we'll get into all that very briefly. But essentially, these responsibility centers are governed based on how a manager and its corresponding or her corresponding accounting network processes different types of accountability practices. And some of the more popular ones and most commonly seen are ones like CVP analysis, cost variable profit, also typically variance analysis as well. It's especially important to pinpoint those two processes because they are incredibly revealing in and telling in what they reveal about a company. So, for example, essentially the best way to analyze where a company is and its projectionary outcome is development of a master budget, which is essentially would be what my role would be as a manager of a responsibility center. So essentially, the budget is the forward-looking yearly fiscal year projection of how a company is alleged to be able to function. That includes those things like unit prices, accounting for inflation, basically all the inputs, and then the projected outputs of whatever unit it is that I'm overseeing. And then that is typically compared to the actual figures at the end of whatever period of time is being assessed. So generally speaking, it's about a year. Sometimes companies will use monthly budget, monthly operating income statements as well, but typically it's projection of how things are deriving over the course of the year. So any fluctuations that are seen between actual numbers and projected numbers or what are referred to as budget variances. And it's especially important as a manager to understand how those come into play because essentially my job is determined based on favorable or unfavorable variances. So if a variance is favorable, that means that my actual expenses were less than the projected expenses. Maybe I brought in more revenue in the end of the actual year than I anticipated in my budget. But both of those are great signs that maybe I am using less amount of material to produce more of a revenue or generate more profit. That's always good to see. CVP analysis works relatively the same way, and it tells me essentially the different aspects of cost, volume, and profit, and it gives more of a snapshot of how well I'm doing. It's also important to note as a manager that a lot of this comes to play with, as I've mentioned, how well I'm doing. And so these budgets that my company would oversee and promote are essentially part of the performance evaluation system. And so any portion of that that reflects any kind of evidence of how well I'm doing would either be seen as a way to compensate me financially, and any shortcomings then are grounds for either reprimand, typically through termination, or some kind of disciplinary action. So that's why those things are so very important. But it's also important to know that I not need to inflate the numbers. So oftentimes, while those budgets are considered great indicators, they can also be inflated and either show less projection so that my numbers look better at the end of the fiscal year, or they can be inflated in such a way that it essentially is a method of fraud. So those need to be not necessarily encouraged, but it actually discouraged. So that's just a little bit about what my assignment pertains to. my role as a manager and holding my unit accountable, and then being held accountable for how well my unit is performing, and ultimately the entire system. So that is all I have, and thanks for listening.